more on the markets, we're joined by Brent Joyce. He's Chief Investment Strategist and Managing Director of BMO Private Investment Counsel. Good to see you.
Good morning.
And a very busy morning here.
It's good to be here on Jobs Day.
What's your reaction to what's happening in Canada right now?
It's quite a mix. The Bank of Canada has got a puzzle on their hands, right? We had what looked like stronger GDP to open the year, and then that gets rained on today with a sour jobs report.
Yeah. On interest rates, how have you been thinking about 2024? What do you think the road ahead is for interest rates in a country like Canada?
Yeah, we're still in the camp that we're going to see rate cuts. The inflation data certainly is giving a green light, or more of a green light than it is in the U.S. for the Bank of Canada. Certainly weakness in the job market, but it's that wage growth number that came in today, again at 5%, that is going to have the Bank of Canada sort of questioning, where do we go from here?
Yeah, and I guess the other part is, if the United States is still rocking and rolling right now, is that a complicating factor, you think, for our timing on pivoting to something like rate cuts?
Yeah, the Bank of Canada doesn't talk a lot about formally looking at the currency, but everybody knows that they do.
Yeah.
We're certainly seeing a move in the loonie today, certainly one that we expected given the different jobs reports. And a lower currency for Canada is a bit of easing in and of its own right. So that's something that they're going to pay attention to. But that strong economic activity in Canada seems to be spilling over from south of the border, and so that's likely to continue.
And all of this happening when the stock markets in North America are at record highs. How are you thinking about what matters most to the markets right now? It is a bit confusing if, the headline from yesterday says that you're seeing weakness in stocks. You've got a Fed official indicating, heck, maybe there's no rate cuts at all this year. And one of the reasons for that would be, yes, inflation being sticky, but also that the economy's been resilient. Then we get a data point in the U.S. today that says the economy is resilient, and right now the markets are rallying. So what do you think matters most to investors right now?
First, Neil Kashkari is a well-known hawk, so the comments yesterday need to be taken with that in light. The U.S. 10-year actually declined after his comments. For stocks, to answer your question, it's about earnings and how we discount those earnings. So you've got this teeter-totter. The stronger economic growth, particularly in the U.S., we would expect to see stronger earnings growth. So you're raising that E in the PE. And how you discount that, let's assume, for example, we don't have any cuts. Well, now we start to raise our earnings expectations, because why don't we have cuts? Wage growth is strong. That's demand in the economy as people have got money in their pockets. A lot of it's related to shelter costs. One person's rent is another person's income. These are better inflation metrics to be worried about than just high food, high energy, which are more of a suck on the consumer and households. Okay,
I want to just get your general portfolio strategy against that backdrop. Before we dive into that, when you think about Canada versus the U.S., investing-wise right now, with both of these markets having momentum, but two different jobs reports presented today, does that influence, does the economic story of both countries ultimately influence where you would lean more, Canada versus the U.S. on the stock market side?
We've liked both markets and have been overweight both markets for different reasons.
Okay.
And it's a bit of, people talk about a barbell approach, right? So the U.S., if we have a stumble globally or things slow down a little bit, you're going to have that very secular growth story that exists there. And then if we see a pickup, U.S. continues to stay strong. We're seeing certainly bottoming in the data in Europe. If China gets its act together, then we've got that commodities and cyclicality story in Canada. And so the two markets are likely to be driven by different things. And whichever way it lands over the next 10, 12 months, we've got an allocation for whichever way it goes.
Okay.